This is AION Investor, today's deep dive for capital that needs an edge in digital assets. Last week, a single 32 Bitcoin sale practically brought down the entire market. 1.6 billion liquidated, 17% structural collapse. If you're managing an institutional digital asset book, the ice is thinner than your models think.
You know, when you're managing a massive institutional book, there's this really comforting, almost seductive illusion of liquidity.
Oh, absolutely.
It's exactly like walking across a frozen lake in the dead of winter. You look down, the ice looks incredibly thick, and your historical depth charts are telling you, hey, it's completely solid.
Right. The quant models tell you the floor is secure, so you deploy the capital.
Exactly. You assume it can hold the weight of your entire portfolio, so you step out. But then someone tosses a pebble onto the ice.
Yeah.
Not a boulder, I mean a literal pebble.
Yeah.
And suddenly you hear this terrifying structural crack echoing across the entire lake.
And that illusion just shatters in an instant.
It really does. And we are looking at a market landscape today that is, frankly, structurally compromised. So today, we are taking the June 6th AION briefing and finding the exact cracks in the ice.
Bypassing all the retail Twitter hype.
Yeah, exactly. We're going to figure out how a tiny, almost microscopic 32 Bitcoin sale practically brought down the entire market. And more importantly, what it means for your portfolio over the next 6 months.
Because, look, for anyone deploying capital right now, recognizing that specific crack before the ice actually gives way, I mean, that's the entire game. Right. It is the absolute definition of a systemic tail risk environment.
So let's set the parameters here. You are listening to this deep dive because you are a fund of funds allocator, you're sitting on an investment committee, managing a multi-million, maybe a 9-figure digital assets book.
You do not have the luxury of trading on sentiment.
No, you need signal-grade research.
Yeah.
So, for this run, we are stepping into our highly structured, rapid-fire, 5-minute macro critique format.
A quick sprint.
Right, a 5-minute sprint.
Yeah.
We are taking the AION daily briefing, dated June 6, 2026, and we are aggressively stress testing its top 3 signals.
And the headline for today's critique is Sailor's Stretch Trap, 1.6 billion in liquidations, and Hyperliquid's edge. We're going to strip away the noise and provide the constructive feedback necessary to project the 6 to 12-month implications for an institutional book.
Because, I mean, the allocation decisions you make in the next 24 to 48 hours based on these signals will heavily dictate your capacity to survive the coming quarter.
Without a doubt.
So let's jump straight into the first signal. The AION briefing highlights this really alarming issue with Strategy's preferred shares.
The ones known in the market as Stretch.
Right, trading under the STRK ticker.
Mm-hmm.
So right now, Stretch is trading at $95.30 against a $100 par value.
Which is significant.
Yeah, that 5% discount is creating a highly quantifiable $561 million confidence deficit.
Mm-hmm.
And amid this deficit, Strategy executed a tiny 32 Bitcoin test sale.
Which is wild.
Right, that 32 BTC sale triggered a violent 17% market drawdown. It literally cascaded into $1.6 billion in liquidations before Bitcoin finally managed to reclaim the 61K floor.
See, what's crucial here is critiquing how the source material frames this data. Because that framing, well, it falls dangerously short for an institutional allocator.
How so?
Well, the briefing cites Bankless, and they casually refer to this as a confidence trap.
A confidence trap.
Yeah, and I want to offer a very direct critique of that.
Yeah.
Calling this a confidence trap fundamentally underprices the mechanical severity of the situation.
Oh, totally.
We need to upgrade this assessment immediately. This is not just confidence. This is a systemic tail risk variable.
Okay, systemic tail risk variable sounds, incredibly ominous. But let's break down the actual mechanics of why that matters.
Sure.
The $100 par value on those preferred shares is essentially a promise, right? It's supposed to be backed by Strategy's massive Bitcoin holdings.
Right.
But Bitcoin natively yields nothing. So to pay the dividends they promised on those shares, Strategy has to generate cash from somewhere. I mean, they are mathematically trapped between a rock and a hard place.
Precisely. And let's look at the math here. The constructive feedback for your investment committee is that your existing risk models are totally obsolete.
The ones built on prior cycle behavior.
Yeah, historical minor capitulation, standard macroeconomic deviation, all obsolete today.
Wow.
They're obsolete because a single corporate balance sheet is now actively dictating the macro market structure. To fund those dividends, Strategy has a binary set of options, and both are completely toxic to the underlying asset.
I want to make sure I'm mapping this correctly because the scale is just wild. The briefing points out that Saylor can either dilute common equity by issuing more shares of the market,
Or he can simply skip the dividends entirely.
right, and if he dilutes equity, the stock price takes a massive hit. If he skips the dividend, the preferred shares collapse.
Exactly.
But then there's the third unspoken option, right?
Yeah.
That he sells the collateral, the Bitcoin, just to fund the dividend.
And that third option is exactly why the preferred shares are trading at 95.30 instead of 100. The market is aggressively demanding a 5% risk premium because they know he's in a corner.
Yeah, they see the trap.
That $561 million deficit isn't just a loss of confidence. It is the market mathematically pricing in the probability of forced selling.
Which creates a mechanical loop.
A vicious one. If Strategy sells Bitcoin to pay the dividend, the price of Bitcoin drops. If the price of Bitcoin drops, their net asset value plummets.
And if the NAV plummets, the peg on the STRK shares deteriorates even further.
Exactly, which triggers more panic. It is a localized mechanical death spiral.
You know, I've got an analogy for this because that 32 Bitcoin sale is just the perfect illustration.
Let's hear it.
32 Bitcoin is nothing in the grand scheme of daily trading volume. I mean, literally nothing. That sale wasn't a market-making move. It wasn't some structural rebalancing.
Yeah.
It was a tracer round fired into a pitch-black room.
That's exactly what it was.
And it illuminated exactly how terrifyingly thin real demand is right now. I mean, 32 Bitcoin wiping out 1.6 billion in leveraged longs. That means the bid-ask depth on the exchanges is practically an illusion.
It's completely hollowed out.
But let me push back on this narrative a bit, just to play devil's advocate. Are we sure the demand is actually that thin, or was this just a classic case of algorithmic liquidation engines cascading into one another?
You mean, is it a structural demand problem or just a temporary leverage flush?
Yeah, exactly.
I mean, it is absolutely a structural demand problem, and the Strategy correlation is the proof.
How so?
Look, if there were deep fundamental bids waiting in the wings, a 32 BTC sale wouldn't move the needle far enough to trip the first liquidation threshold.
Oh, that's a really good point.
The fact that it did means the market is acutely aware of the MSTR overhang. Market makers pull their bids the literal second they see a corporate wallet associated with Strategy initiate a transfer.
Because they're terrified. It's the beginning of a larger dump to fund those dividends.
Precisely. The floor is entirely load-bearing, and Strategy is the only pillar right now.
Okay, so if I'm sitting on the investment committee right now, running a massive book of Bitcoin correlated beta, what is my 6 to 12 month implication here?
The implication is that this is a rapidly compounding signal.
Compounding, not fading.
Exactly. Over the next 6 to 12 months, if the stretch peg deteriorates without some stabilizing macro event, forced selling somewhere in the structure becomes inevitable.
Wow.
Managers running Bitcoin-correlated beta strategies must rewrite their risk models today. They have to include MSTR corporate action as a primary variable.
And if they don't?
If your underlying managers are not actively pricing in the volatility of the STRK peg, they are exposing your portfolio to catastrophic, unmodeled tail risk.
Yeah, you cannot just run a standard beta playbook when the beta itself is structurally intertwined with a single corporate entity's debt obligations.
You really can't.
Which perfectly bridges us to the next massive signal in the briefing. Because if the foundational asset, Bitcoin, has this massive corporate balance sheet overhang dictating its price action.
Allocators can't just hide in passive beta anymore.
Right. They are being forced to look further out on the risk curve for actual durable yield.
Right.
And that leads directly to the brutal structural divergence happening on chain right now.
Yeah, and this is where the survival of a fund-to-funds portfolio over the next year is truly going to be decided.
For sure.
The macro overhang is pushing capital to find safe havens of yield. But, you know, the definition of a safe haven in DeFi has fundamentally changed.
Let's pull the data, the AION briefing compiled from the block and the Defiant here. We are seeing two completely opposite realities.
Starkly different.
Yeah. On one side, you have Hyperliquid. Their treasury stands entirely alone in the ecosystem, generating actual quantifiable operational profit.
Which is incredibly rare.
Right. And on the flip side, you have legacy crypto DAO treasuries bleeding billions of dollars. And the absolute poster child for this bleeding today is the news about Helium.
Oh, yeah.
Their founder, Amir Halim, has exited as CEO of Nova Labs, while the HE token is currently trading 99% below its peak.
99%. I mean, once again, we really need to apply our critique format to the source materials framing here.
Go for it.
The AION in brief passively calls this a structural divergence.
Too soft.
Way too soft. For an institutional allocator, divergence implies two assets simply moving in different directions on a chart.
Right, like normal market ebb and flow.
Exactly. But what we are actually looking at is a glaring systemic indicator of capacity decay in legacy tokens.
Okay, capacity decay. That is a term that gets thrown around in VC pitch decks all the time, but let's ground it for the listener. Are we just talking about DAOs that issue a ton of inflationary tokens to pay for user acquisition, but have absolutely no revenue coming in the back door?
That is the exact mechanism, yes.
You're watching AION Investor, the daily deep dive on digital asset flows, on-chain signals, and macro for capital allocators. Every weekday, AIONpowerhouse.com.
Capacity decay is the mathematical point where token inflation completely outpaces organic fee generation.
And it permanently destroys the token's ability to capture or hold value.
Exactly. These legacy protocols, especially in the decentralized physical infrastructure or DePIN space, built their entire models on zero interest rate assumptions.
Oh, for sure.
They assumed they could endlessly subsidize operations by just, printing governance tokens.
It's like a subscription fitness app that is literally paying its users $100 a month just to keep the app installed on their phones.
Right.
While only charging them $10 in actual fees. So the user metrics look incredible on paper, the growth charts are up and to the right.
But the moment the VC cash, or in this case, the token inflation runs out,
the illusion of a user base vanishes completely.
That is a perfect mechanical analogy. They have no actual business model. They just have a runway that is rapidly vaporizing.
And helium is the ultimate stress test of this.
It really is. They issued HNT to incentivize people to buy and deploy hardware hotspots. But the demand to actually pay to use that network never matched the inflation required to build it.
Yeah, not even close.
So the founder exiting and the token down 99%, that isn't just a bad quarter. It is the realization of terminal capacity decay.
But wait, let me play devil's advocate for the managers who are still, holding these bags.
Sure.
Because a lot of institutional money chased that dip-in narrative over the last 2 cycles. They bought into the idea that you bootstrap the hardware network first with token incentives, and the revenue eventually follows once the network is ubiquitous.
That was the dream, yeah.
Are you saying the entire thesis is completely dead, or just that the market is temporarily impatient?
I am saying the thesis, as executed by legacy DAOs without an immediate path to profitability, is a fading signal. It's done.
Wow, done.
The cost of capital is simply too high now for allocators to subsidize vaporware. Contrast Helium's model directly with Hyperliquid.
Okay, let's look at Hyperliquid.
They are a decentralized perpetuals exchange. They aren't relying on complex multi-year hardware deployment schemes. They have real traders executing real volume and paying real trading fees.
Yeah.
The protocol captures the spread and the fees, and that value accrues directly to the treasury. It is a structurally sound business model that generates positive unit economics today.
Real operating cash flow.
Exactly.
It's almost wild that making more money than you spend is considered a revolutionary concept in crypto, but
yeah.
I mean, here we are.
Here we are.
So what is the clear directive for the listener on this one?
Over the next 6 to 12 months, on-chain business models that generate durable value will siphon virtually all institutional capital out of the broader DeFi ecosystem.
Just a massive rotation.
Total rotation. The directive is urgent. You must immediately audit your underlying managers, dig into their DeFi books.
Check their exposure.
Right. Are they holding legacy DAOs hoping for a governance token renaissance? Are they still modeling a bounce for inflationary DePIN tokens?
And if they are,
then your manager risk is at a critical level. They must be actively rotating out of these legacy bleeders and positioning to capture the structural yield of profitable treasuries like Hyperliquid.
a flight to quality, where quality strictly means proofable cash flow.
Precisely.
Okay, so we've established the macro overhang with the strategy trap, and we see the massive capital rotation toward actual yield in DeFi. But the market rarely reprices these realities on its own without a spark. What is the catalyst that forces this entire landscape to suddenly shift?
Which brings us to our third signal.
Right, the regulatory timeline.
And this is the piece of the AION briefing that requires our absolute harshest constructive feedback regarding prioritization.
Let's look at the data. The block is reporting that comprehensive draft crypto tax legislation is actively circulating in Washington right now.
Right now.
And this is happening just ahead of a highly anticipated House Ways and Means Committee hearing scheduled for next week. Now, the AION brief buries this.
They completely bury it.
They stick it all the way at the bottom in a tomorrow's watch list section, basically flagging it as something to casually monitor for headlines while you drink your morning coffee.
Which is a catastrophic miscategorization for an institutional book.
Yeah, it really is.
Relegating tax legislation to a watch list implies it's a future problem that you deal with when the ink dries. I argue this is an immediate 24 to 48 hour risk layer.
I see what you're saying, but let me push back hard here, because I sit in these investment committee meetings.
Okay, go ahead.
D.C. legislative hearings are almost universally political theater. It's grandstanding for the cameras. We've seen 100 of these crypto hearings over the last 5 years. They go absolutely nowhere.
That's historically true, yeah.
And even if a draft bill is introduced, it takes years to pass, and it gets watered down 50 times along the way. So why on earth would an institutional allocator or quantitative fund rewrite their models based on a leaked draft and a hearing next week?
Why not just wait for actual laws?
Yeah, why not just wait for enforceable laws?
Because markets are forward-looking discounting mechanisms.
Always.
The very moment a realistic probability of a tax shift enters the market, the basis points of return are fundamentally altered.
So it's not just about compliance.
It isn't just about regulatory compliance at all. It's about valuation models. Let's tie this directly back to the two things we just discussed.
Okay, let's see it.
How are Strategy's potential Bitcoin dividends going to be taxed under this draft? If they are taxed unfavorably, the risk premium on that $561 million STRK deficit skyrockets instantly.
Ah, okay. I see where you're going with this.
Right.
And let's look at the DeFi side, too. If Hyperliquid's treasury yield is currently being modeled by a quant fund at a pass-through tax rate,
Yes.
and this draft legislation suggests, say, a 25% corporate tax burden on decentralized protocol revenues,
Then their discounted cash flow models update the millisecond that draft hits their Bloomberg terminal.
the basis points shift instantly.
Exactly. Algorithms literally scrape the transcripts of these committee hearings in real time.
Wow.
If the lines of questioning next week suggest bipartisan support for taxing on-chain business models heavily, the market will reprice the entire curve before the hearing even gavels out.
So this is what we mean by a macro overlay.
This is exactly what we mean.
For the listener, define how a manager should be using a macro overlay in this specific instance.
A macro overlay is essentially a top-down risk parameter applied across all underlying manager portfolios to adjust position sizing based on broad systemic probabilities.
Oh, wait.
If your managers are not running a macro overlay that prices in the probability of this draft legislation today, they are effectively flying blind.
Yeah.
Waiting for the law to pass means you become exit liquidity for the sophisticated funds that priced in the draft legislation during the hearing next week.
That is the defining line right there between retail thinking and institutional thinking.
Without a doubt.
Retail waits for the law to pass. Institutions trade the probability of the draft.
Okay.
And if you wait, you are the exit liquidity.
Oh,
Okay, we have covered a massive amount of dense, highly actionable ground in this critique. Let's synthesize the critical directives for the listener's investment committee based on this deep dive.
let's do it.
First, the core beta is compromised. The Bitcoin market structure is technically holding, but it is deeply scarred. The 1.6 billion liquidation cascade proved that the floor is terrifyingly thin.
And almost entirely dependent on the strategy balance sheet overhang.
Exactly. The STRK preferred share peg, sitting at a $561 million deficit, is your ultimate canary in the coal mine. You absolutely must model for the probability of forced selling.
Second, regarding sector rotation, we are witnessing the death of zero interest rate tokenomics.
Yeah.
Legacy DAOs and narrative-driven depend tokens like Helium are experiencing terminal capacity decay. You have to audit your managers immediately.
Okay.
Right. If they're holding inflationary tokens without corresponding protocol revenue, their manager risk is unacceptably high. They must rotate into on-chain business models like Hyperliquid that capture real fees and generate structural profitability. Cash flow is the only durable safe haven.
And finally, the regulatory repricing catalyst is not a future event to monitor. It is imminent. The draft tax legislation circulating ahead of the House Ways and Means hearing next week threatens to alter the fundamental basis points of return across the entire sector.
Which means your managers must be running a macro overlay that prices in this risk immediately.
Or you risk severe portfolio degradation when the broader market updates its discounted cash flow models next week.
These are not theoretical exercises or, long-term thought experiments. These are the harsh allocation realities that demand action in the next 24 to 48 hours.
So we'll leave you, the allocator, with one final, deeply unsettling question to mull over as you prepare for your next investment committee meeting.
What's the question?
If a mere 32 Bitcoin test sale can expose a hollow floor and trigger a 17% structural collapse today, and leaked tax legislation threatens to permanently impair the valuation models of the only profitable on-chain businesses next week.
Yeah.
How confident are you that your underlying managers aren't currently mispricing their liquidity assumptions by a catastrophic order of magnitude?
It ultimately comes down to whether you have the systems in place to hear the crack in the ice before it gives way beneath you.
Remember, that 32 Bitcoin sale was just a tracer round fired into a dark room. Now you know exactly what's hiding in the dark and how thin the ice really is. You have the signal-grade analysis you need, time to make the deployment decisions. We'll catch you on the next deep dive.
That's your AION investor briefing. Subscribe to keep the signal coming. New episode tomorrow.